Meantime, Dow is leading the Dow higher. Best Dow component of the year so far to date. Dow's up 142. Let's get to Bob Pisani. Hey, Bob.
And that's a good point, Carl. Material stocks, stuff that was lagging last year, is doing better this year. So let's take a look at the sector gainers. Materials are on fire. All of these stocks are up 6-7% so far this year. The copper producers, real estate, big laggard last year. It's doing well. Consumer discretionary is doing a lot better. It helps that you have Amazon and Tesla stabilizing. And what's lagging? One of the winners last year, comparative winners last year, is healthcare. And you can see that today. Pfizer's down. Here's lagging. Bristol Myers is to the downside a little bit. Pfizer's had a terrible start. It's down about 8% for the year. Lamb's down. Salesforce down. We had that downgrade over at Bernstein. But we are off to a very good start for the year. It doesn't feel that way, I know, but actually this is one of the better starts we've seen in a long time. Dow Transport's up almost 6%. The Russell's up, outperforming. That was a terrible performer last year. It's outperforming. NASDAQ's outperforming. S&P 500 up 2.5%. By the way, the rest of the world is doing even better. Europe, which had a terrible year, underperforming the United States, is doing well. The Stoxx 600, this is sort of the S&P 500 of Europe, is up almost 6% this year. Look, that's the highest level since April. We're 8% from a new high in Europe, 8% from a new high. And China is outperforming. China had a terrible year. You see all these underperformers tend to outperform in the next year. You see that move up there, and that's not far, maybe 15% from a new high as well. Elsewhere, we're going into earnings season, and a lot of talk about dividends. I know you don't think they're exciting, but they were huge last year. We had a record year for dividend payouts last year because the cash flows of corporate America are really strong, and the margins are still high. And the estimate is will likely continue into 2023. The important thing here is that investors have been throwing money into dividend-yielding funds. Dividend-yielding ETFs took in massive amounts of money last year. They tend to favor ETFs where companies are increasing their dividends year over year. So, for example, Noble, which was one of the big dividend payout companies that were around last year, NOBL, dramatically outperformed the S&P 500. Put that chart up. Look at that by 10 percentage points. They own companies like Procter & Gamble, for example, that tended to outperform last year, and they paid roughly 3%. 4% dividend yields for these companies overall. I know you don't think dividends are interesting. It was about 2%, 1.7% on the S&P 500, but it's a critical component of overall returns. Here's why. Most people reinvest the dividends that they have. These dividends are compounded on a yearly basis, and over time, they are a critical component of overall stock returns. You cannot look at yearly price returns on the S&P. Carl, the average yearly return on the S&P for the last nearly 100 years is 10.2%. Of that return, 40% is from reinvested dividend. The other 60% are price returns. This is why dividends are not boring. Reinvested, critical part of the investor perspective. Carl?